So let me start with talking about our ETF. And this is going to be 2 minutes because I am not in the ETF business. Wisdom Tree is in the ETF business. I got into the index business and I created the Bianco Research Total Return Index, which is coming next, my explanation. And that'll take 5 minutes, and then the rest of the call will be on the 2024 outlook. And there is an ETF, WTBN, Wisdom Tree. There it is in the upper left in the corner, Wisdom Tree Bianco. It is going to track our index. It is a NASDAQ listed ETF, and so it's just like any other ETF. And what you're looking at on the screen here is the prospectus. And I would encourage anybody that is interested in this to look over the prospectus. It is listed on, should be listed on most platforms that you could trade it just like anything else. And if you've got any issues regarding the ETF, you can reach out to me. Okay, so that's the ETF. The next thing I want to talk about is our index, because that's what I'm doing. We have created, and now this is the website, it's biancoadvisors.com. And we've created the Bianco Research Fixed Income Total Return Index. Now, what is this? We started off with a benchmark broad-based investment grade index. Covers 10,000 plus bonds. It looks very much like all of the other broad-based investment grade indexes, because when you have an index that big, they all look pretty much the same. And we are running this index as a long-only strategy. So we are always long the market. We have, if I was to jump onto the index characteristics page or the factors page, we have identified 5 factors that we believe drive the total return of an index. Duration, are you long or short the index? And I'll talk about what we are in a second. The yield curve, are you bulleted betting on a yield curve steepening or barbell betting on a yield curve flattening? Your credit weighting. Now remember, these are all relative to the benchmark because we're always long. Volatility or structure, that would be mortgages. Are you long or short or overweight or underweight? That might be the better words to use relative to the index. And other would be outside of the index as far as where you think we're going to be. These factors drive what I think is going to be total return. A couple of words about indexes before I move on to where we are in the index currently, and then explain for the rest of the call through my 2024 in outlook why we are there. So if you're thinking about, oh, you've structured an index, it's run by a committee, and if you want an analogy, S&P has an investment committee that runs the S&P 500. Bianco Research has an investment committee that runs the Bianco Research Total Return Index. S&P is not an ETF business. Everybody that has an ETF that tracks the S&P 500, BlackRock, Vanguard, Wisdom Tree, on down the line, they're in the ETF business. We are not in the ETF business. Wisdom Tree is in the ETF business for us. So that's analogous to what we've done. Now, we will try and position of being overweight or underweight these factors relative to a benchmark, always long, to try and outperform. Oh, but nobody can outperform an index. Well, that's largely historically been the case in equities. 95-ish% of strategies in active managers in discretionarily run indexes cannot beat the S&P 500. That's true. In fixed income, it's more like 50-50. It's more what you would have thought before you looked into it. Shouldn't the index kind of be in the middle of where, you know, either discretionary indexes, what we are, or active management is? Yes, it is in fixed income. And there's various reasons for why that is. One of the big ones is you tend to get most of the borrowing from over-levered countries and over-levered companies, that tend not to be good credits and tend to be very shaky credits, so your biggest weightings are in your problem children. Where in equities, your biggest weightings are in your all-stars. You know, so your biggest weightings are in Apple and Amazon and Google because they've run up a ton and they've increased their weightings, and that's good. You want to be long those. But in fixed income, your biggest weightings are in troubled companies and in Japan and in Italy and companies and countries that have way overborrowed and have provided subpar returns. And that's why maybe the index is somewhere around the 50th percentile. So the approach that we are looking at is that we can maybe structure this index or our weightings so that we can outperform the index a little bit better. So index updates on our website, and then I'll turn to my 2024 outlook. When our investment committee meets, and I'm the chairman of the investment committee, we update on this webpage our positioning in the index. Currently, we are 90% of the benchmark, so we are a little bit short of our benchmark, being defensive on the idea that interest rates may rise. Now, 90% is not, a maximum short for us. We could go all the way to 50% in extreme cases, and shorter if we believe so that rates are going to head up. And I will address that, all of these, why we are there in the 2024 outlook, because that's kind of the explanation of our positioning. We are equal weighted with the benchmark on the curve. So if you were to break our index into buckets, the 1 to 3, 3 to 5, 5 to 7, 7 to 10, 10 plus, our weightings are roughly, or 100%, as close as we can to being similar to those weightings. Now, why are those weightings very similar on the benchmark? Because the yield curve is so flat, there's not really a lot of opportunity yet, we don't think, to make money in a bulleted structure or a barbell structure. That will come, but it isn't right now. Structure or securitized, we're 71% of the index, so we are more defensive on that. That means that we're underweighted mortgages and we're underweighted structure, and that's because of the high volatility in the bond market, and that tends to make these positions underweight. You can see we put together a chart here of the option adjusted spread of mortgages and the the MOVE index, which is the old Merrill option volatility estimate. It's like the VIX of the bond market, and they move together. And so if we're going to stay in an elevated period of volatility, which we've been in all year and continue to be, I've got some charts again in the 24 outlook. It's set next. I'll explain that. Then this should be a challenge as well too. And then on credit, I'll just start off by pointing out the chart. The blue line on the chart is the credit spreads, investment grade credit spreads, option adjusted spread. And the orange line on the chart is the S&P 500. Your credit weighting is your equity weighting. We're slightly short on the credit weighting at 91%. Now remember, this is investment grade credit as well. High yield credit would be considered in our last section, which is an outlier bet. We don't have any high yield currently in our index. What we do have is a 20% positioning in short tips, 0 to 5 year tips. Because remember now, a tip is a treasury inflation protected security. A tip is basically you get the inflation rate plus a yield on top of that, and that yield on top of that is running at around 1.5% or so. So I get the inflation rate plus 1.5%. That is a very attractive security or sector right now. And so we've got a 20% weighting. In the short end, we didn't want it to be muddled with a long duration bet, which would be whether or not rates are going up or down. We want to try and capture that yield. So that's where we are in terms of our index. The index committee meets. It meets at least monthly, sometimes intermonth if circumstances dictate it. And we adjust those weightings. And when we adjust those weightings, we will publish it on this website. BTR INDX is our index on Bloomberg. You could track our index on Bloomberg, and WTBN is the ETF that tracks our index as well. So that is for that section of the handout. Now